Welcome to this week's episode of Taking Stock for the week ended the 23rd of June 2023. I'm Matthew Swartz, the Senior Portfolio Manager for the Funds business, and I've been handed hosting duties today in Kian's absence for the very first time. And to help me debut in the hot seat is the rising star in our equities team, Daniel Ortiz. Welcome, Dan.
Yeah, thanks, Matty. Good to be here. It's a very busy week for us, hasn't it been, with the AI presentation and certainly a lot of market volatility. So lots to talk about in today's episode.
Yeah, plenty to talk about, Dan. But before we do that, a quick yet important reminder that the information we provide during this episode is of a general nature and should not be taken as personal advice. Remember, shares are volatile and any charts or tables we present should not be relied upon as a guide for future performance. Okay, so there's been a fair bit going on this week in markets from sky-high UK inflation to more downward pressure on our local retailers. But to kick things off, Dan, I think we'll touch on some interesting developments in China. So the PBOC, or the People's Bank of China, last week cut rates to stimulate their waning economy after manufacturing, property, and even consumer confidence figures disappointingly missed expectations. And if you all recall, economists and investors alike were quite confident that the end to their zero COVID policies would spark a big economic response, but so far that's failed to materialise. So Dan, I know you know this space quite well. How are you seeing the resources sector reacting to this news of rate cuts?
Yeah, it's a great summary, Matty. And I guess from the market's perspective, there certainly is more hope and expectation for further stimulus measures coming out of China. And what this has done is kind of support commodity prices such as iron ore in recent weeks. However, despite the potential rebound in commodity prices across the board, we still feel that the market has moved too quickly on these stimulus hopes. And there is always cautious about trying to forecast commodity prices. So as such, we are a little bit less optimistic, given the underlying data, as you mentioned, such as local property sales, new development starts, and property prices in China really at the moment are not too supportive. So we do prefer those really high quality mining stocks with adequate financial health and, of course, low cost operations to manage commodity price volatility. These include Star Income stock, BHP, and obviously Rio Tinto. In terms of our growth stocks, Matt, our focus really has been on more of the battery commodity exposures, such as lithium and rare earths, whereby the data for EV sales have been far more supportive.
Yeah, totally agree there, Dan. So let's switch up into other news. And we saw the Australian Competition Tribunal deny the multi-operator core network, or the MOCN deal between TPG and Star Growth and income stock Telstra. Could you give us a little bit of colour on this update?
Yeah, certainly. So the deal was initially intended to allow TPG and Telstra to share certain network assets in regional areas, and this would allow them to improve overall coverage range and speed for rural customers. Overall, however, analysts had around a 6% earnings uplift for TPG, whilst Telstra's impact was a lot more muted, estimated at only roughly 1% of earnings for the following year. However, since the deal was originally declined last year by the ACCC before being appealed, there was a low probability for success priced in by the market. Hence, this really didn't impact how the market is valuing Telstra and why the stock didn't really react negatively on the day, Matt.
Well, that's good. It's comforting to know that shareholders and the impact to Telstra appears to be minimal. And it would appear, though, reading between the lines, that the real winner here is Optus, who would have likely lost market share if the deal had eventuated. Now, let's pivot again to another segment of the economy that we talked about earlier, which is the Australian retail sector. It seems that the tightening of monetary policy is beginning to see meaningful reduction in discretionary spending. And Best and Less Group this week, a player in the discount retail market, joined the growing list of retailers to update the market with disappointing numbers. And during the months of May and June particularly, like-for-like sales were down by as much as 13% in comparison to the previous corresponding period.
Yeah, that's correct, Matt. And it really is a noticeable dip for the company, whereby they now expect to deliver total revenue between 310 and 315 million and a net profit after tax of between 3 and 4 million. Now, to give our listeners some perspective, this is a significant decrease compared to the company's previous guidance of over 10 to 12 million in profits. So clearly the performance of Best and Less Group is under severe pressure.
But we do note that the Best and Less is currently under takeover from Brett Blundy Associated Businesses, hence the muted share price response to those poor numbers. But their disappointing results has heaped pressure on the rest of the space, or continued to heap pressure on the rest of the space. And it's highlighting the vulnerabilities in the retail sector more broadly. And this was really the driving force behind our decision to remove Premier Investments from coverage as a Star Growth and Star Income stock. Please refer to our analyst commentary or contact our analyst team if you require any further information about the business. Now, our corporate calendar. Casting our eyes to the company announcements next week, we have APA Group, Arena REIT, BWP Trust, Charter Hall Long WALE, Charter Hall Social Infrastructure, and Waypoint, all going ex-dividend. And in Under the Microscope this week, we take a closer look at recent inclusion into the borderline Star Growth universe, Xero Limited. The company recently released its financial year 23 results, demonstrating its renewed strategic focus on profitable growth. As such, underlying cash flows improved materially from 2 million in the prior period to over 102 million in the full year result.
Yeah, that's right, Matty. And profitability is certainly anticipated to ramp up further, which was a key driver of our current investment thesis. Members can see that earnings forecasts under Golden Rule 3 have increased significantly, and the stock will likely meet our Stock Doctor growth criteria in the near term. Furthermore, the accounting software market will continue to benefit from certain structural tailwinds, as small businesses and enterprises are increasingly transitioning to cloud-based solutions. The current penetration rate is sitting only at roughly 50% for the market.
There's a long runway for growth here, isn't there, Dan? And the improvement in profitability will also translate into more stability in its financial health rating, which has previously been a bit of an issue. The company currently has a net cash position and has access to over $1 billion in financing, supported by an improved cash flow profile. So in terms of past and future performance, Xero is very likely going to look like a very different business, with some analysts forecasting a future return on equity above 14%. And investors who are sensitive to valuation, however, should be aware that Xero is trading close enough to its consensus estimates, and it is on over 100 times forward earnings.
And aside from valuation, other active risks members should be aware of are slower than forecast international growth, cybersecurity breaches, and rising insolvencies amongst SMEs due to higher interest rates.
So Dan, following our AI presentation earlier in the week, the question of this week is which Australian stocks are primed to benefit from this AI megatrend?
Yeah, it is certainly a great question, Matt. And according to some of the feedback we received from members, there is a lot of confusion about whether there are genuine opportunities here in Australia. So first, we might take a look at what we can consider direct exposures, perhaps those companies powering the AI ecosystem, such as semiconductor designers, manufacturers, and technology developers. For this, we can use our stock filter tool on Stock Doctor. Here, I've added financial health rating, market capitalization, return on equity, and of course, business description containing artificial intelligence. Now, from the list on screen, we can see that whilst there are opportunities, they are quite early stage and speculative in nature. Now, this is what you'd expect given the investment and adoption rates are much lower here in Australia than, say, the US, for example.
Yeah, we did touch on that point, didn't we, Dan? And whilst there are a genuine lack of immediate beneficiaries on the ASX, one aspect we discussed during the presentation was the broad adoption of AI into our lives and how that will really impact almost every industry over time. And there are a variety of stocks on the market that can exploit the opportunity. For example, here are some of the companies we outlined in our presentation, which we believe will be nearer-term beneficiaries of this broader AI theme. So stocks like Pro Medicus and WiseTech can integrate AI into their market-leading software. And stocks like Telstra will experience improved operating efficiencies with the implementation of customer-orientated automation. And finally, with this intensity with regards to demand for cloud computing, we expect that data center operators like Macquarie Technology should also be a beneficiary.
All great points, certainly there, Matty. And it really is a paradigm shift that will over time come to benefit and also disrupt many companies. So it does reinforce the importance of active stock management and constant analysis. Of course, sticking to company fundamentals such as financial health and those return efficiency metrics we follow. Clearly, however, the US is the real place to be for direct exposure to some of these global giants powering the AI ecosystem. Perhaps, Matt, you touch on a few of those opportunities that we discussed. and you also own the US Growth Fund.
Sure, I'd always love to talk about the stocks in the Lincoln US Growth Fund. So, for example, Alphabet, as we all know, the owner of Google, global titan with fingers in many different pies across the spectrum of opportunities in artificial intelligence. Arista Networks, they're a hardware producer similar to Cisco Systems, where their hardware products will be powering telecom towers and data center racks. And lastly, a stock, Adobe, which many of you will be quite familiar with. They're a global leader in design software who are beginning to implement generative AI for their customers. So for those of you interested in our US fund, be sure to reach out to us on 1300 676 333 and ask to speak to our fantastic relationship managers in Michael McCurry and James Albanus to hear a little bit more. Okay, so that's just about a wrap, Dan. So thank you so much for joining me and for your insights.
Yeah, busy week this one, certainly. And hopefully the members like the new look team presenting today.
I'm sure they will. And if you do have any additional questions about today's episode, feel free to participate in our Lincoln Live webinar next Monday. Note that Tim and Ken will both be away. So again, it'll be Daniel, myself, Robbie, and Jason Yin to host that content. And with the end of the financial year fast approaching, it may be a good time to introduce Stock Doctor to your family and friends so they can take advantage of all the upcoming promotions. You can either do this by the Refer a Friend tab or send them to a link to the free trial page. So in summary of today, whilst there are some positivities from this China stimulus story, it is difficult to forecast commodity prices with a high degree of certainty. So stick to the companies with the solid fundamentals. Remain cautious about stocks within your portfolio that may be at risk of earnings downgrades, such as those in the retail sector at the moment. And remember to keep track of new changes in the Star Growth universe, as our analyst team is actively assessing changing market conditions all the time and are providing you with timely updates on their commentaries. Have a happy, healthy, and prosperous week ahead, everybody.